Net worth and income are the metrics everyone tracks. If you look at your bank app or talk to a traditional advisor, those are the numbers they lead with. But I want to suggest something today that might feel a bit uncomfortable. Those numbers are actually useless for predicting your future. In the world of economics, we call them lagging indicators. Think of it like looking in the rearview mirror while trying to drive a car at 80 miles per hour. Your net worth today is simply a receipt for things you did months or years ago. It tells me where you have been, but it has zero power to tell me where you are going. High income is just as fragile. I have seen people making $500,000 a year who are actually closer to bankruptcy than a teacher making $50,000, simply because they have no headlights. If you want to know exactly where you will be in 10 years, you have to stop staring at the results and start looking at the mechanics. We need leading indicators. Today, I'm going to walk you through what I call the Wealth Velocity Triad. These are the only three numbers that actually matter if you want to predict your financial outcome with mathematical certainty. Before we dive into the first number, I want to make a quick deal with you. I know your time is the most valuable asset you own, and you are probably bombarded with generic financial advice every time you open this app. My goal is for this video to be the highest ROI on your time you spend all week. If we get to the end of this and you feel like you have a better grasp on your future than you did 10 minutes ago, consider hitting the subscribe button. It helps the channel, but more importantly, it keeps this kind of deep dive, no fluff framework in your feed. I am not here to sell you a dream. I am here to give you the math. We are going to break down these three leading indicators in a way that allows you to calculate your own trajectory by the time this video is over. It is time to stop guessing and start forecasting. Let's look at the first pillar of the triad, which is your engine of optionality. It is the number that dictates the literal countdown clock to your freedom. Most people track how much they save in absolute dollars. I hear it all the time. People tell me, "Tom, I am finally saving $1,000 a month." And look, saving $1,000 is objectively better than saving nothing. But, as a leading indicator, that number is deeply flawed. It lacks context. If you save $1,000, but your lifestyle costs you $20,000 a month, you are actually in a very precarious position. The first number in the Wealth Velocity Triad is your savings rate. This is the percentage of your gross income that you do not spend. I like to think of the savings rate as the ultimate measure of financial efficiency. It is the gap between your ego and your income. As Morgan Housel points out, wealth is really just the stuff you did not buy. When you track the percentage instead of the dollar amount, you are measuring something much more profound than just a pile of cash. You are measuring your ability to control your own behavior. Most of the people I see struggling are not struggling because they do not make enough money. They are struggling because they have never defined the gap. They let their expenses chase their income like a shadow. If your income goes up and your savings stay at a flat dollar amount, your efficiency is actually dropping. You are becoming less likely to reach freedom, even though you feel richer. There is a mathematical certainty to the savings rate that most people completely miss. Back in 2012, a guy named Pete Adney, who most people know as Mr. Money Mustache, wrote about the simple math of early retirement. He proved that your time to retirement is almost entirely independent of how much you earn. It is entirely dependent on your savings rate. Think about why this is. Your savings rate does two things at the same time. First, it tells us how much capital you are generating to buy assets. Second, it tells us how much money you actually need to survive. If you save 10% of your income, you are living on 90%. That means for every year you work, you save enough to live for about 1/10 of a year. You have to work a long time to build up enough for a lifetime of leisure. Specifically, at a 10% savings rate, you are looking at about 51 years of work. But if you can jump that to 50%, the math changes drastically. Now, for every year you work, you save enough to live for an entire year. You are essentially buying back your life at a 1-to-1 ratio. At a 50% savings rate, you are done in about 17 years. When you look at your savings rate today, you are looking at a literal countdown timer. It is the most honest number in your portfolio because it accounts for the cost of your lifestyle, which is the one variable most people ignore until it is too late. Why is it so hard to maintain a high savings rate? It usually comes down to something called Parkinson's law. In the world of productivity, the law says that work expands to fill the time allotted for it. In the world of money, it means expenses expand to meet income. This is the trap of the six-figure earner who still feels broke. Every time they get a raise, they subconsciously decide they deserve a nicer car or a bigger house. They keep their savings rate at a flat 5%, even as their salary doubles. They think they are winning because their net worth is slowly growing, but their leading indicator is actually signaling a disaster. They are locking themselves into a higher cost of living that requires them to work even harder just to stay still. I have seen this happen to friends who hit it big in tech. They go from a 50% savings rate as students to a 5% savings rate as executives. On paper, they look wealthy. In reality, they have lost all their optionality. They are now on a golden hamster wheel. To fight this, you have to treat a raise as a trap for your ego. The next time you get more money, do not change your life. Keep your expenses exactly where they are. That move alone can jump your savings rate by 10 or 15% in a single day. That is how you compress decades of work into years. It is about being a hero in your spreadsheets, not a celebrity in your neighborhood.
So how do we optimize this today?
First, you have to calculate it relentlessly. Take your total monthly savings and divide it by your total monthly gross income. Do not use your net income. Use the gross. This forces you to account for taxes and everything else. If you are under 15%, you are in the danger zone for a traditional retirement. If you want to guarantee a positive outcome in 10 years, I want you to treat 20% as your absolute floor. The second step is to automate the sweeps. Human willpower is a finite resource. If you wait until the end of the month to see what is left over, the answer will almost always be zero. You have to pay your future self before you pay your landlord or the grocery store. Set up your direct deposit so that your target percentage goes into a separate account before you ever see it. If you never see the money in your checking account, you will not spend it. You will naturally adjust your lifestyle to fit the remaining 80%. It is a psychological hack that uses your own laziness in your favor. Once you have the engine running with a solid savings rate, you have solved the first part of the triad. But saving is just the start. Now we need to talk about what you actually do with that gap, because cash is a leaking bucket. Wait, before we move on, I have to address a huge mistake I see people making. They get their savings rate up to 30%, they feel great, and then they leave all that money in a standard savings account for 5 years. They think they are being safe. But in a world of persistent inflation, that safety is an absolute illusion. If you think that a 7% tax on your income is bad, wait until you see what happens to your purchasing power when your money sits idle. Inflation is the silent thief that eats 40% of your retirement if you do not know how to outrun it. This brings us to the second leading indicator in our triad. If the savings rate is the engine, this next number is the transmission. It determines whether all that effort you are putting into saving is actually moving you forward or just making a lot of noise while you stay in neutral. Let's talk about the investment rate. The second metric in the Wealth Velocity Triad is your investment rate. This is the percentage of your total savings that is actively deployed into income-producing or appreciating assets. Most people confuse saving with investing, but they are two very different animals. Saving is for preservation. It is for your emergency fund, or the down payment on a house you want to buy next year. It is meant to be boring and stable. Investing, on the other hand, is for growth. It is where you trade your fiat currency for ownership in things that produce value, like index funds, real estate, or businesses. To predict your outcome in 10 years, I need to know how much of your capital is actually in the game. If your investment rate is 0, you are essentially betting that the value of the dollar will stay the same or go up. Historically, that is a losing bet. Over any 10-year period, the purchasing power of cash tends to melt. If you are sitting on a huge pile of cash because it makes you feel safe, you are actually choosing a guaranteed loss of purchasing power over a statistical probability of growth. Your investment rate tracks how efficiently you are shifting capital from the preservation bucket to the appreciation bucket. In my experience, people who stay middle class focus on saving. People who become wealthy focus on deployment. They want every dollar they own to be a little soldier out there fighting to bring back more dollars. Let's look at the math to see why this matters so much. Imagine two people, Sarah and John. Both of them have been listening to this, and they both managed to save $2,000 a month. That is $24,000 a year. Over 10 years, they both put away $240,000 of their hard-earned labour. Sarah is cautious. Her investment rate is only 10%. She keeps $1,800 in her checking account every month and only puts $200 into the stock market. After a decade, she has a huge pile of cash, but it is still just about $252,000. Now look at John. John is a deployer. His investment rate is 90%. He keeps a lean emergency fund and puts $1,800 a month into a low-cost S&P 500 index fund. Assuming a standard historical return of 8%, John's portfolio grows to over $330,000. In just 10 years, John has $100,000 more than Sarah, even though they worked the exact same amount and saved the exact same amount. If you extend that out to 20 or 30 years, the gap becomes so large that Sarah will never be able to catch up. Sarah worked for the money. John's money worked for him. This is why the investment rate is a leading indicator. It tells me if your wealth is going to grow linearly or exponentially. Linear growth is a job. Exponential growth is freedom. If you want to know where you will be in 10 years, I don't care how much you have in the bank. I care how much you have in the market. The reason most people have a low investment rate is fear. They look at the stock market and they see volatility. They see the headlines about crashes and they decide to wait until things look safer. But here is the secret. Things never look safe. Volatility is not a bug in the system. It is the price of admission for long-term wealth. To have a high investment rate, you have to accept that your portfolio will likely drop by 10% every single year and by 20% every few years. If you cannot handle that, you will stay in cash and inflation will eat you alive. I often tell people that the stock market is the only store where customers run out of the building when there is a sale. When the market is down, your investment rate should actually stay the same or go up. You are buying units of production at a discount. If you treat the market like a casino, you will have a low investment rate because you are scared of losing. If you treat it like a supermarket, where you are buying future income, you will want your investment rate to be as high as possible. Tracking this number forces you to face your own risk tolerance. If you find yourself keeping more than 6 months of expenses in cash, you are suffering from a wealth velocity leak. You are choosing the comfort of a big number in your checking account over the reality of a growing net worth. Optimizing your investment rate is about creating a system that bypasses your emotions. First, you need to cap your cash. Sit down and figure out your exact emergency fund number. For some, it is $10,000. For others, it is $50,000. Whatever it is, Once you hit that number, your investment rate for every new dollar saved should immediately shift to 100%. No exceptions. Do not let your cash reserves creep up just because you are nervous about the economy. Second, you need to simplify your deployment. You do not need to be a stock-picking genius to have a high investment rate. In fact, trying to be a genius often leads to lower rates because you spend too much time overthinking. Use low-cost, broad market index funds from places like Vanguard or Schwab. They offer the highest probability of sustained, compounding returns over a 10-year horizon. Every quarter, I want you to look at your total net worth and ask what percentage of it is sitting in uninvested cash. If it is more than 15%, you are losing velocity. You are leaving money on the table that your future self is going to desperately need. Once the engine is efficient and the transmission is engaged, we have to look at the one thing that can pull the emergency brake on your entire life: the trajectory of your debt. Now, tracking these percentages can feel like a lot of work if you are just using a napkin and a calculator. I have spent years refining the exact mathematical systems I use to track my own Wealth Velocity Triad, and I have made them available for you. If you want to stop guessing and start seeing your trajectory on a real graph, check out the Tom Talks Money digital templates in the description below. I have built out an ultimate personal finance dashboard that calculates your savings and investment rates automatically. There is also a debt payoff tracker specifically designed to show you the trending direction we are about to discuss. These are the same tools I use to run my own financial life. They take the emotion out of it and give you the raw data you need to make better decisions. They are the best investment you can make in your own clarity. Go grab those at the link below, and let's get into the third and final leading indicator, which is the most counterintuitive of them all. The final metric in our triad is the debt-to-income trending direction. Now, if you have ever applied for a mortgage, you know what a DTI ratio is. The bank looks at your monthly debt payments and divides them by your income. They want that number to be under 40%, so they know you can pay them back. But for our purposes, the static number is almost useless. If you just bought a house, your DTI might look high, but that doesn't mean you are failing. To predict your wealth in 10 years, we don't look at the number. We look at the first derivative of the number. We look at the trending direction. Is your debt-to-income ratio expanding, or is it contracting? This is the vector of your financial obligations. When you take on debt, you are essentially borrowing from your future self. You are taking money you haven't earned yet and spending it today. That means a rising DTI trend is a signal that the future version of you is becoming poorer and poorer. Every time that line moves up, you are promising a larger chunk of your future labour to someone else. I have seen people with huge salaries who have an expanding DTI trend because they keep financing toys and vacations. They are building a prison for themselves, one monthly payment at a time. If the trend is pointing up, your 10-year outcome is likely a crisis, no matter how much you make today. Let's compare two different paths. Imagine Mark and Elena. Mark makes $6,000 a month. A few years ago, his DTI was 16%. He had some student loans and a small car payment. But then he upgraded the car. Then he financed some furniture. Then he put a vacation on a credit card. Now his DTI is 33%. Traditional banks say Mark is fine because 33% is considered acceptable. But the Wealth Velocity Triad says Mark is in a doom loop. His trend is positive, which means he is relying on leverage to sustain his life. In 10 years, the interest on that debt will eventually choke out his savings and investment rates. He is moving toward a cliff. Now look at Elena. She also makes $6,000, but 2 years ago, her DTI was a terrifying 41%. She was drowning in credit card debt. But she made a choice. She stopped borrowing. She paid off the cards and her DTI fell to 30%. Then she paid off the car and it fell to 16%. Traditional metrics might have called Elena high risk a few years ago. But I look at her and see a future millionaire. Her trend is steeply negative. Every time she clears a debt, she frees up cash flow. That cash flow doesn't go toward a new car, it goes into her savings rate. Elena is building a wealth snowball that will eventually become unstoppable. The direction of the line matters so much more than where the line starts today. Now, we have to be smart about this. Not all debt is created equal. I generally categorize debt into strategic leverage and consumer drain. A mortgage on a home you plan to stay in for a long time is usually strategic. It causes a one-time spike in your DTI, but because the payment is fixed and your income will likely rise over 10 years, the trend will naturally point down. That is a healthy trajectory. Consumer debt, like credit cards or high-interest auto loans, is always a drain. When I track the DTI trending direction, I focus primarily on consumer debt. If your consumer DTI is trending upward, you are succumbing to lifestyle creep. You are using debt to fund a life you cannot actually afford. According to the Federal Reserve, Americans are currently holding record amounts of credit card debt. Most people are in an expanding trend right now because of inflation and the desire to keep up appearances. If you want to be in the top 1% in 10 years, you have to do the opposite of the crowd. You have to be the person whose debt line is constantly moving towards zero. When your DTI hits zero, your wealth velocity hits its maximum. At that point, every single dollar you earn belongs to you. You are no longer an indentured servant to your past choices. You are the master of your future ones. To master this leading indicator, you need to perform a quarterly audit. Every 3 months, I want you to calculate your total monthly debt payments divided by your gross income. Put that number on a line graph. If the line isn't pointing down, you need to stop all non-essential spending immediately. You are in a wealth leak. To fix an upward trend, use the avalanche method. List your debts from the highest interest rate to the lowest, and pour every spare dollar into the top one. This destroys the interest payments as fast as possible, which bends your DTI curve downward more aggressively. Most importantly, you have to freeze consumer borrowing. Make a pact with yourself that you will never finance a depreciating asset again. If you can't buy the TV or the watch in cash, you simply cannot afford it. This rule alone halts any upward pressure on your DTI trend. By keeping your debt trajectory pointed towards zero, you ensure that as your income grows, your wealth grows even faster. You are clearing the path for your savings and investment rates to do their job. When all three of these numbers are optimized, you don't have to guess about your future. You can see it coming from a mile away. It is a mathematical inevitability. This is where most people stop. They have the three numbers and they think they are done. But I'm going to show you why most people still fail even when they know the math. Conventional wisdom says that as long as your net worth is positive, you are fine. I'm going to tell you that you can have $1 million net worth and still be on the path to being broke in 10 years. It sounds impossible, right? But it happens every day to people who ignore the interaction between these three metrics. Let's look at the final synthesis of the Wealth Velocity Triad by comparing two very different people over the next decade. This is where we see the difference between a high earner who is trapped and a middle earner who becomes a titan of their own life. Let's talk about high-income Harry. Harry is the guy everyone envies. He is a senior executive making $250,000 a year. His net worth is $400,000. By every lagging indicator, Harry is winning. But let's look at his wealth velocity triad. His savings rate is only 5% because he is maintaining a massive house and luxury car leases. His investment rate is 20% because he keeps most of his money in a checking account to cover his high bills. And his DTI trend is expanding because he keeps taking out lines of credit for renovations. In 10 years, Harry will have earned $2.5 million, but he will be financially trapped. Because his savings rate is so low, he has no margin for error. If he loses his job, he collapses in months. Now look at strategic Sarah. She makes $80,000. Her net worth is only $20,000. By traditional standards, she looks average. But her triad is elite. Her savings rate is 25%. Her investment rate is 95%. And her DTI trend is contracting because she is paying off her last student loan. In 10 years, Sarah is mathematically guaranteed to be wealthier than Harry in terms of optionality. She will have a portfolio of over $300,000. Her expenses will be low, and she will have total control over her time. Harry has a high income. Sarah has high velocity. Velocity always wins the long game. If you are the kind of person who likes this level of granular detail, you might want to join a group I call the Optimizers. You can do that by clicking the Join button right next to the Subscribe button. Members get priority replies to their comments, so if you have a specific question about your own Wealth Velocity Triad, that is the best way to get a direct answer from me. You also get some custom sketch badges that show up next to your name. It is a small way to support the channel and join a community of people who are actually serious about the math of money. We are moving away from the surface level talk and into the real systems that build freedom. I would love to see you in there. Now, let's wrap this up with the most important paradigm shift of all.
The financial industry wants you to focus on your net worth because it feeds your ego and it is easy to sell. But ego doesn't build wealth that lasts. If you want to take total control of your destiny, you have to stop looking in the rearview mirror. You have to focus on the things you can control today. Protect your engine by maximizing your savings rate. Engage your multiplier by maximizing your investment rate. And control your trajectory by forcing that DTI trend downward. When you optimize these 3 leading indicators, you don't have to guess where you will be in 10 years. You will already know. The math doesn't lie, and it doesn't care about your feelings or the current headlines. It only cares about the efficiency of your system. I want to hear from you in the comments. Which of these 3 numbers are you going to focus on first? Are you an engine person, a transmission person, or are you working on the brakes? Let's treat the comment section like a peer review. Share your goals or your current percentages if you are comfortable. We can all learn from each other's data. I am Tom, and this has been Tom Talks Money. I will see you in the next one.